of every $100 the U.S. government is spending, about 60% comes from revenue and 40% comes from debt.
Right.
And historically, once you go over that 40%, you're really on the road to hyperinflation. I wanted to get your thoughts. Do you see a hyperinflationary outlook for the dollar as the U.S. government tries to fulfill its promises and just turns to Mr. Bernanke and the printing press to give ever worthless dollars to fulfill those promises?
It's certainly possible. The way I think about it, James, is they're almost like tectonic plates pushing against each other. Now, when you've got two powerful plates pushing against each other, just because there's no earthquake today doesn't mean there's not a lot of tension building up. There is. We have natural deflation coming from the Depression, and we have inflation coming from policy. Now, the fact is they're pushing against each other. The actual inflation measures, CPI, if you can believe it, are around 2%. So economists would say that's fairly well behaved. But that's not stable at all. It's what physicists call a minimally stable state. In other words, the forces are still there, and that's going to break at some point. When? It's hard to say. I wouldn't necessarily tomorrow, although it could be tomorrow. But which way will it break? Will Bernanke, in effect, throw in the towel and say, look, we've done all we can do. We've just got to take our medicine and let this deflationary part of the cycle play out, in which case deflation might prevail? Or will he double down or triple down or do whatever it takes, as they've said? I think that's more likely. And then you just get into the risk of hyperinflation. What's interesting to me is that gold wins either way. Gold has, very intuitively always been a strong inflation hedge. But what a lot of analysts don't understand is that it's a very good deflation hedge as well. During the 1930s, that was the greatest prolonged deflationary episode in U.S. history. Gold went up 75%. Homestake mining was the best performing stock on the New York Stock Exchange. So gold has a history of doing well in deflation as well also.
Yeah, I agree with you on that. The way I describe it is gold is a monetary problem hedge. Regardless what that monetary problem is, inflation, deflation, bad banks, sovereign credit crisis, you name it. People will go to gold in order to protect themselves when there's uncertainty about the monetary outlook.
Right. I think I come out in the same place. Here's how I describe gold. I say gold is not a commodity. It's not an investment. And it's not a trade.
You sound like me.
Gold is money. Yeah. And if you want some money, you better have some gold. And in real terms, its value changes very little. I was talking to someone the other day, and I said, well, I think I can see gold at $7,000 an ounce. Not tomorrow, or it might be a couple of years, but I can definitely see it at $7,000 an ounce. And the person was surprised, and they said, really? Is that true? You really think it's true? I said, well, I do think it's true, but bear in mind, the gold won't actually be worth any more. The dollar will be worth less.
Yeah, we'll be paying $7 a gallon for gasoline or whatever.
Exactly. But it is a way to preserve wealth, and it is a way. It is the one true store of value.
Yeah, I was discussing that this morning with a reporter, and the way I was explaining it is that gold is not an investment because it doesn't create wealth. And he was saying, well, the price of gold goes up, and I said, well, the purchasing power of the currency is going down. Right. And he said, well, doesn't gold go from undervaluation to overvaluation? And I said, yes, it does, but it's not creating wealth. It's just merely redistributing it from people who are holding paper currency to people who are holding gold. Right. And that's, I think, how it's going to continue playing out until at some point in time in the future, gold becomes overvalued, and then you're going to want to use it to get into undervalued assets, whatever they might be at that future date.
Correct. I think that's exactly right. I agree with that, and I think there are objective ways of figuring that out. For example, the $800 gold price in the early 80s, that was objectively a bubble. You could say it was a bubble. Why is that? Because when gold was $800 an ounce, the market value of all the official gold of the United States was greater than the money supply. It was more than 100%. Everybody with a dollar could have walked down to the Treasury, handed it in, got gold at market value.
Greater than M1.
And greater than M1. There would have been gold left over. So even, as a gold advocate, a gold standard advocate, I can see a case for, 40% gold backing. It depends on the politics and the mechanism, but the hard shell gold advocates say, no, it has to be 100%. But nobody thinks it has to be 110%. My point is, when you see it getting to that level, it's a bubble. But how far away are we from that? Well, right now we're very far away. I mean, that number today would be about $7,000 an ounce. But bear in mind, it's a moving target. By the time you get there, M1 may have doubled again, and it'll be 14. So
if we're working on quantitative easing number 6 at that stage, who knows what the gold price could be?
That's right. So it's less important to pick a number in my mind than it is to understand the dynamic. Because when you understand the dynamic, you can just plug in the numbers as variables and get to the right place.